Hey there, you guys. Before we jump into today's video, I just wanted to take a moment and to remind you that as a big thank you for hitting the 400,000 subscriber on my channel recently, I'm hosting a huge giveaway happening right now. So to find out how you could win up to a $250 gift card, a free ticket to my virtual workshop, and other really great prizes, just click the link in the description of this video to enter my 400,000 YouTube subscriber giveaway. So enter today. Now back to the video. Well, hi, you guys. I'm Phil Town from Rule 1 Investing, and today I want to talk to you about whether we can predict the next market crash. Well, the market's been doing some crazy things this year, right? Going all over the place. Some stocks going completely crazy from the Reddit guys. Other stocks going crazy from hedge fund managers. It's really, really interesting to watch. And many people are expecting some kind of major market correction to happen very soon. Certainly Warren Buffett's one of them. He's sitting on $150 billion in cash. But can we actually predict it? Is it possible? So I'm going to talk to you guys today about whether or not it's gotten, impossible to predict market crashes, and what's the likelihood of a major market crash actually happening. So let's get started. I think we'll start with a kind of historical metric, these really important views of the market that go way, way back in time, like the Shiller P ratio and Wilshire GDP. And I've talked about these before here. But let's just chat about them again. Shiller P, developed by Robert Shiller at Yale, got the Nobel Prize for it in 2013. And it is a ratio that tracks the cyclically adjusted prices of the stock market against its earnings. And what they found is, and what Shiller found is, it's amazing, is that the stock market tends to be on about a 16 PE ratio on the Shiller PE, or 16 Shiller PE ratio on average. And right now it is at 38. Now, the reason that that's significant is because there have only been 3 other times in history where it has been anywhere near this. The first time happened in 1929. We got a depression. The second time happened in 1999, and we got a huge crash. The third time happened in 2007, and we got a huge crash. And here we are again. So that's one reason to think maybe a crash is coming. The second is a Wilshire GDP, which Warren Buffett has called it's kind of called the Buffett ratio because he's talked about this. And that is the relationship between the total amount of sales or revenue in the United States against the price of the stock market, the general stock market. The Wilshire GDP you can find by just going to FRED, which is the Federal Reserve in St. Louis, and Wilshire GDP, and the chart will come up. What it'll show you is that when I first started investing, the relationship between the total price of the stock market and the revenue of the United States was that the stock market was at about 25% of revenue. And then it went up and up and up. And by the year 2000, it was at over 100% of revenue. When it got to 120%, Buffett said, you're playing with fire. And sure enough, we had a market crash. Same thing happened in 2009. And here we are today. You're not going to believe this. I mean, remember now, 120, 130% of GDP looks like a very pricey stock market. We are at 238% of GDP right now. It's completely nuts. I've never seen anything like it in history. So that's probably one of the big reasons Buffett's sitting on $150 billion in cash. Now, the next thing that's happened that's going to promote some serious problems here is that the Federal Reserve has a job of trying to keep full employment. That's sort of what they created the Federal Reserve Bank about. And in order to do that, they have historically raised interest rates in order to stop inflation and to slow the economy down so we don't have a depression at some point. And then they lower interest rates to stimulate the economy, because when people can borrow money easier, everything works better, right? And so what the Fed did in 2009 in order to stimulate full employment was they dropped interest rates and dropped them and kept dropping them, and nothing happened, and we didn't get full employment, and they dropped them all the way to 0, and we still didn't get full employment. So then they stepped in and just printed money. They printed about $4 trillion. Now, the way they do that is they just make an entry in the Federal Reserve Bank assets and liabilities. They make an entry that says, we have $4 trillion. They can just do that. The only bank that can do that in the United States. They do that, and then they took the $4 trillion and they bought treasury bonds with it. And that's how the government got the money. So what that did was put $4 trillion into the economy that wasn't there a minute ago without any change in the actual material growth of wealth. And the result is a devaluation of the currency. Well, also people kind of tend to feel better about things when the economy starts to work, which it finally did after about 8 years of this kind of thing under Obama. And then Trump stepped in and really cranked it up. Now, meanwhile, the Federal Reserve tried to raise interest rates during Trump's administration to slow down the growth of the economy and try to get things back to normal. But the moment they raised interest rates, the stock market had risen so much based on these low interest rates that it immediately started to crash. And so they very quickly stopped doing that because they didn't want to throw the stock market into a complete rout. So they went back to just sitting quietly with zero interest rates. And then we had COVID show up. And all of a sudden, they felt the need to print a whole lot of money. They printed $6 trillion over the 2020 year. And then today, we're now continuing to print over $120 billion a month. And with that money, they're buying assets like, this is great, treasury bills for sure. Also, mortgage bonds. Also, exchange traded funds that are doing things like corporate bonds. So the Federal Reserve is continuing to put in on an annual basis about $2 trillion. They just passed another resolution to put another $1 trillion into the economy in the form of infrastructure rebuilding. So that's $3 trillion that we know for sure they're going to put in this year, but I'm sure the Democrats are going to try to do even more. And that's going to mean in the ballpark of $10 trillion into the U.S. economy. Now, to get a grip on what that is a typical year, our total amount of sales in the whole economy is $20 trillion. That's how much money's moving around. And they just added another 50% to that. Now, what's going on because of that is called inflation. Inflation has started up with a vengeance. And the question is going to be, is it permanent? The Federal Reserve is coming out very strong and saying, oh no, it's not permanent. It's just because there's been a real supply shortage as a result of COVID, and that's causing prices to go up temporarily, but the supplies will kick back in and the prices will come back down. And they may be right. But then again, housing is going up at 15% a year, and it's not included in the cost of living index. Housing, apparently you don't have to live anywhere. Oh, you also don't have to eat. Food is not included in a really serious way. Energy also not included in a serious way. So, oh, by the way, neither is college or education. So none of those things are counted for inflation. And as a result, inflation from the Fed's view looks kind of anemic. It's not quite going very fast. But out here in the real world where we have to buy things like houses, gas, food, and college and education, it looks like inflation is really, really strong. It's going to be really interesting to see if things like housing prices come down to reflect a change in inflation. I seriously doubt it. And that means a lot of people are also looking at this like inflation is here to stay, and it can be a self-fulfilling problem. So the result of all this is a couple of things. Number one is the Federal Reserve could continue to keep interest rates low because they're afraid to raise them because of what it'll do to real estate and the stock market. If they do that, inflation will really take off, and then we're going to have some serious hyperinflation. Now, I don't know how they'll get out of that, but usually the way they get out of it is a massive devaluation of currency and typically a massive recession. That's the very thing they've been trying to avoid for 10 years. Now, the other possibility is the Fed will quietly start raising interest rates, and that's what they've been saying they're going to do. And I'll tell you what, the moment they do it, this stock market is going to take a tumble. The question is, how far will it go? I don't have the answers to that, so we're going to do what we always do, which is just forget about predicting the market at all. All we're going to do is try to be sure we understand that when the market is greedy like it is right now, we want to sell things. And when it starts to get very fearful, which will be the next level of the cycle, we want to buy things. So we got to get ourselves ready, right? Presumably, we've already sold whatever we need to sell right now because this market's crazy. And everything you own should be very high price, should be very, very much above its intrinsic value. And as a result, certainly is in my portfolio, so we're selling things off. And so what we're going to do then is start to create a list of companies that have meaning to us, that have real value to us in the world, that match our values, that reflect the way we want to see the world, and also have a very large moat, some kind of durable protective advantage that keeps them protected from competition. We also want management team that also walks their talk, right? Everybody's got a great line of chatter about how they're such a great company. We want management that really does take care of its people, takes care of the environment, takes care of suppliers, and really looks out for the investors as well. We want great management teams. And finally, we want a great big margin of safety. Now, the margin of safety is the easiest part of all this, because that's just going to get handed to you by Mr. Market doing what Mr. Market does, which is to get manically depressed or manically manic, whichever he happens to be in. Right now, manically manic, and the market just keeps going up. But when he gets depressed, we're going to get our margin of safety on all these wonderful companies. So now what I want you guys to do is get good at this. And to do that, just download my free guide. It's linked in the description of the video, and you can learn more about these 4 M's, meaning, moat, management, and margin of safety, that are critical to you doing well in the coming crash that we're going to get someday. So now I'd like to hear from you guys. Do you think the market's gotten hard to predict in terms of a crash? So just leave a comment below with your answer, and I'll be sure to follow up with you. And thanks for watching, you guys. Now go play. Hey, if you enjoyed this video and you feel it was valuable in teaching you more about whether or not it's gotten harder to predict market crashes, or if you can even do it, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And by the way, don't forget to click the button on the screen for a free gift. And thanks again for watching.